sales from 2022 to 2024 actually dropped off about 50%. Now that's huge, but it wasn't because of the prices of the real estate. It was because the volume of sales from inventory. People just weren't bringing properties to the table. So rates probably aren't going to go up anymore. This looks like it's going to be a good setup for the end of this market. We needed to get to the point where supply came back into the market. That's the one barrier that was keeping us from making the shift into the next market. Hey, what's up all of my real estate peeps? This is Brian Lucier with another episode of the Why Not Real Estate Podcast Golden Nuggets, where we will take some tip, tactic, or technique and unpack it that you can use it for your rental business to improve your operations and make money. Well, all my real estate peeps, I have a special golden nugget for you today. Really excited to share this with you. So if you go back in the archives, and this goes for just about any podcast, when they do a market trend, you need to kind of look at where you are in the market. So if you watch something from a year ago, things may have changed. So about a year ago, we had Brian Burke on the show and Maureen Miles and some other huge investors who were talking about the market and what they saw happen. And now we're going to fast forward. And even this show, a year from now, you may go back and look at it and say, well, gee, that's not really how it panned out. And that's okay. So let's dig into what we've got today. If you go back into the archives, there's been an issue holding back the turn in the market cycle. And that issue has been inventory. Historically, we've been shy about 4 to 5 million rental units or dwelling units. And now that gap has closed. We'll get into that in just a little bit, but I've been watching some of the shows on Bigger Pockets, and I want to unpack what I just saw Brian Burke and David Myers, what they're talking about. I want to use that for this particular show. We're seeing the market slowly starting to shift, and we're seeing an opportunity for expansion in residential, but it's happening slowly. So this is the fun part. First, I got some quotes from Brian Burke to set the tone of the show. He used to be saying, survive till 25, and now they're saying, end the dive in 25. Brian Burke thinks we're going to be hitting the bottom out on prices in the larger multifamily market, probably third quarter 2025, but we're going to see where all this ends up in time. Next, they've got the market fixed in 26, investor heaven in 27, in 28, you'll be too late. So these little whimsical quotes here kind of outline where these top investors see the market going. So over the past 3 years, you could buy a rental property pretty much anywhere in the country and look like a genius. But now we're starting to see the residential is over those volatile shifts. It's poised for steady growth, not in all markets, but we do see that the residential markets that have survived the interest rates were people still buying. Interest rates did affect supply and sellers because sellers weren't willing to sell knowing that they'd have to turn around and buy something else at a higher interest rate. They currently own properties at those great gravy rates of 3-4%, and they just couldn't come to the table to sell that and take the equity off the table, knowing they'd have to buy something at a much higher interest rate. So because of this, sales from 2022 to 2024 actually dropped off about 50%. Now that's huge. But it wasn't because of the prices of the real estate. It was because the volume of sales from inventory. People just weren't bringing properties to the table. So rates probably aren't going to go up anymore. This looks like it's going to be a good setup for the end of this market. We needed to get to the point where supply came back into the market. That's the one barrier that was keeping us from making the shift into the next market. So here's a fun fact, right? Some of us have been used to these great gravy years, or if you're a new investor seeing rates at 3 or 4 or 5%, you thought, wow, this is fantastic. Well, over the past 50 years, the average normal mortgage rate has been 7.7 to 8%. So we're pretty much hitting where we're supposed to be right now. Some people don't like it because they were used to the other rates, but now we're at a good baseline point for where the normal average is. We're now entering a new cycle with lower housing affordability. People just cannot afford to buy houses. This is really bad news for home buyers, but it's great news for the long-term buy and hold investors, which a lot of us watching this and our guests on the show are. So there'll be a huge demand for rentals eventually, and rents will go up. This new cycle is going to force people to bring strategy back into the game. It was very easy the past couple of years to just buy something with low interest rates and rents going up and make money. It was a perfect storm of making money in real estate. Rents were rising like crazy, but now they've leveled off and actually cooled, and they're not seeing those double-digit increases they used to be. So your buying now is going to require long-term vision. Cash flow deals have tightened. You can still buy a property for cash flow, but it's not going to have the margins you maybe were used to when you were buying at lower interest rates. So now you need to earn your equity through a value add play and buying the property right. You have to add these factors into your game now. The large multifamily market has been rough. In the multifamily market, larger multis, the prices have been sliding, and here are some of the reasons. The cost of capital. It takes longer to do these projects. Your holding time is longer. The cost of the capital is higher because of interest rates. And there's a lack of growth rent right now. We're just not seeing it. There's a lot of people in the game who did multifamily who are now just holding water. They're burning through their reserves. They haven't had to do a cash call yet, but eventually they're going to run out of time and run out of the resources. So this would be the time to buy in these markets before the rents start rising and climbing back up again. So as I said, in the past 3 years, you could buy just about anything and the value went up. Now you need to work it for the value add play. So large multifamily, Brian Burke feels, may be close to the bottom of the market in 2025. So this is a very attractive market niche. The smaller apartment building sector, it takes work to find these deals. There's a lot of needle in the haystack, and a lot of these were the mom and pops who wouldn't sell knowing they'd have to buy something at a higher interest rate. But these are deals where you can still make a lot of money. These are going to be your twoplex, your duplexes, your 4s, 6, 8s, your 10s, 12s, even 20-unit properties. There's that niche. It's outside of what your smaller investors are going to buy, and it's smaller than what your bigger investors are going to buy. And these are the deals. I mean, it's going to take a lot more work to find these deals, but these are the people who weren't willing to sell because they'd have to buy at a higher interest rate to get their equity out. Now that the interest rates have settled down, people are getting used to it. Okay, we've seen it actually drop a little bit, so now the fear is down a little bit, and these deals may be coming available coming out to the market. So for the buyers in the market, it's been 3 years. They haven't been doing anything, but now these players are starting to come back into the market looking for deals. For the larger multifamily market, there are still some issues that need to work through the pipeline before it's going to be the perfect storm again. You've got maturing bridge and mezzanine loans that are going to come due, and then that may force the sale of a property. You've got construction now. A lot of permits have been pulled. Developers have gone into the market and added inventory. So now we're going to be on the flip side of inventory where there'll be too much supply. So your new inventory that's been added from 2021, 22, 23, 24 is now going to be hitting the market, and it's going to hit equilibrium. It's also, for these developers, it's taking them longer to complete construction projects. Permitting process and electrical code and so many other archives in the yellow podcasts, you can find out where that's all been and where's that going. But it's just taking longer, and it costs more to complete these construction projects. And the inventory constraints are going to tighten after these projects finish in 2025. When all this inventory gets out there, it's going to start getting consumed. Then the rates are going to start to raise again with fewer units to choose from. But this isn't going to be overnight. This is going to take time. These units have got to get built. Absorption needs to happen. Then it needs to hit equilibrium, and then rents will raise again. So this is what we've been waiting to happen. We talked to the other investors on the show, their strategy. They're talking about keeping their gunpowder dry. So oversupply and absorption, those are going to be the key indicators. This is what we've been waiting for. So just a short while ago, there weren't enough dwelling units. Now construction is adding these units at a faster rate in which they can be consumed. This isn't in all markets. Mostly this is in the markets that were doing the best for rental returns and double-digit rent increases annually. But now that the market turns, it's the time to go before you miss this. So these great markets were in the Sunbelt, now are getting crushed. This is where you had your double-digit annual rate increases. But why did this happen? Well, there was a 10, 20, 30% annual rent growth. That was great. So what happened? The developers noticed this. They came in and started to build. They added inventory and brought equilibrium, and then they went over and added too much because there was the opportunity to make money. Now the construction to the absorption ratio is off. There was too much construction, not getting absorbed fast enough. Needs to settle down. This is going to drive prices down for a bit. It's going to make rents stagnant until the absorption takes effect on all this new inventory. Now in these markets, there's going to be too much inventory, and this is going to be the time to buy over the correction period. When the people hate something, that's the time to buy it. When the people love something, that's the time to sell it. As soon as you can see the trend, then it's too late. What can you do to take advantage of a turning cycle? It's easy. Know your buy box, know what you're buying, know your parameters. Watch your metrics. Where's population going? Where's inventory going? Where are the permits going? Know your market. This is 101. You have to know the market you're buying in. Have your team, boots on the ground. Have a value add strategy. That's going to be so important in this turn of the market, because buying for the cash flow you were used to getting with the lower interest rates isn't there anymore. And then finally, stick to your plan. So like Brian Burke says, it's the end. The end of the dive in 25, the market fixed in 26, investor heaven in 27, and in 28, you'll be too late. So keep your eye on the market, know where it's going, know what you have to do. Be prepared. We are entering a new market cycle. It's going to be a good time to buy rentals again. I hope you found this golden nugget useful. I loved doing the research for this. I was very excited to see the stats and see where all this was going. I always enjoy learning more about the market, and I hope you do as well. So again, all those smart investors for the past 3 years, they kept their gunpowder dry, but now it's time to aim and hit their target. So I really hope you enjoyed this. Market's going to change. Corrections are coming, and it'll be time to buy again. This is Brian Lucier from the Why Not Real Estate Podcast Golden Nugget signing off, and we'll see you on the next one.